Good afternoon. Welcome to this back to basics session. I'm going to focus mostly around, around mindset today. So I'm going to talk a little bit about rejection in the markets. I'm just laughing because, yeah, I just remembered an old analogy I used to use. Um, I can't believe I used to use that analogy. Maybe I'll share it with you. But when it comes to rejection, but anyway, going to talk a little bit about rejection. There's in two different forms. Um, but what gives me or has given me the idea for this today is twofold. When I did the live YouTube broadcast last week, some of the comments where it's the usual stuff. Once we start talking about mindset, then people say, "Oh, I'm really struggling with this or with that." It's all around that sort of subject, uncertainty, and all that, really. So let's kick that off. So two different types of rejection. You've got the rejection of um, getting into trades and getting stopped out. But I also want to talk about uh, getting into trades and almost it feeling like you're on the wrong side of the market, or you go underwater. You've got your stop loss, but you go underwater on a trade and it feels like, oh god, I'm on the wrong side of the market. And the point is that in real time we don't know, but that's why we have to constantly be working ahead of taking a trade so we can deal with all of that. Otherwise we get too caught up in it. So as soon as you go underwater you start thinking, oh no, it's not going to work, or whatever, I'm on the wrong side, I've got it wrong, or whatever. So of course that's why in advance we have to do it, but also picking examples as reminders to us of the amount of times, because it's amazing, we have this innate ability as human beings to get caught up in the moment of the next trade, um, but very quickly we forget the times previously, whether it's through actual real experience or just, for example, if we've gone back testing something, how many times a trade will go underwater. So I'm going to talk about that element first of all, and then move on to the other type of rejection too. So just clearing down messages. Ooh, the point of no return. Oh, I see. Right. Yeah. No. The point of no return. Hi, Sue. That reminds me of Phantom of the Opera. Past the point of no return. Da, 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 da. Anyway, for those of you who've seen Phantom of the Opera, my voice was just like the Phantom's there. Is it the Phantom who sings that bit? Can't even remember. Anyway. Right. Anyway, let's move on. So, I've already talked about this just recently. You did, Sue. Yeah, you did indeed. Right. So when I'm going to talk about, even I'm going to talk about this part here because I remember shorting the euro somewhere here, but the euro sort of held up, and really you have to go into the detail of it. So actually, let's just take this back for a minute into replay mode. Pretty sure that I would have short. It was 105.80. Let's have a look. Did that go to 105.80? 105.87. I think I shorted on that day, yes. Because literally the following day, oh, did it come down? Oh, darn it. Okay, it came down a little bit. And I think it came down. Let's have a look. There we go. Right. Somewhere around there I'd shorted. And you imagine in real time, you're in a trade. Well, it doesn't matter what the time frame is. So you're in a trade, market starts to run for you, and you're thinking, okay, this is fine. And then it bounces back. So see if I can get there. Here we go. So at that point, and probably the day before, it's very easy to start thinking, oh, I've probably got this wrong. that's quite a big candle to the upside. I know this one ended up being a bit of a shooting star type bar, but nevertheless, can you imagine during the day? And this is the thing. This is why I always say it's important to go back when you're back testing, or just going back over past events, look at how it actually played out. Because when we just look at a cluster of price action, if we don't put it into our charts into replay mode, if you haven't got replay mode on your charts, get a piece of paper. That's what I used to do. Put a bit of paper blocking what happened next, so you can see more of what it looked like in real time. Because in real time at that stage, I'm sure it'd be you'd be thinking, and especially when the euro prior to that was a news day, it was a non-farm payroll day. Um, Maybe you got on the wrong side. My stop was wherever it was at that point, 105.80, 106.80, wasn't it? Right. So how far did it come? 106.30. Right. Okay. My point is that you can get into trades and it feels like you're on the wrong side. So whether price just keeps retracing, or it looks like it's starting to move like in this occasion and then starts turning back up, in real time, you're probably thinking, maybe I'm on the wrong side, and that is true. Maybe you are on the wrong side, but there's no point worrying about it, and you just because you don't know how a trade is going to play itself out. So why bother worrying about it, sort of thing. And the more that we go over past events, as I keep saying, the more that we see, yes, the times when they do just do something else and may have stopped us out, or in a situation like that. But it's useful to see, oh, okay, when it feels like you're on the wrong side in real time, it's not always going to be the case, because I think it ended up rolling back over, and then all of a sudden, okay, right. So yeah, that's confirmed a lot more now by the time it's rolled down. So it's this sort of situation that we're constantly battling with. So my phone's going off. Do you want to exit yet? We're constantly sort of having to contend with in the markets, whereby you put positions in, and a lot of the time they don't go straight in your favor. They might, especially if you're selling a retracement or buying a pullback. You're not always going to be catching the absolute low, and or selling the absolute high. When you do, yeah, bonus, but it's not always going to be the case. So it's good to go back over that and just remind ourselves and make notes on it that, oh yeah, no, that's just because it pulled down a little bit there doesn't mean to say it can't come back up, and then still ended up rolling over. A good, I mean, and the uncertainty of real time. If we go back to, you imagine, okay, so after Trump had got in, yeah, won the presidency, won the election, should I say? This is what it looked like in real time. That was the election day. Then we had a big bounce back day, and then we started coming off. And I think I sold the following day. And you imagine in real time how, again, this is why it's useful to do this, because in that instant, I was waiting for, okay, well, if we break down through the low of the election day bar, all right, I'll sell it. And I think that's what happened there. So I sold it on that. So, but it's very easy to get caught up in the, oh yeah, but this, but that. You're selling it right down there, but it's not necessarily certain when it had the bounce day there either. So you get into a trade, and at that, and it's gonna feel like, even in real time, okay, it's coming down a bit, but it's still got to show itself really, and so show its real intent, and then it starts progressing. You think, okay, it's a little bit better, but still going to be vulnerable to retracements and all of that stuff that goes on in real time. So my point of today's session is again is just going back over time and time again, back over past instances where certain patterns have taken place. Um, and if I just get rid of that again, and seeing how the price moved post it. Sometimes it just moves away straight away. Other times it consolidates and chops around, because all of that helps us for when we're in our next trade, starting to feel a little uncertain. There's nothing wrong with feeling a little bit uncertain to the outcome, because that's the bottom line. We don't know what's going to happen. But what we don't want is to be getting overly emotional. And so, because we don't know what the outcome's going to be, the bottom line is we put a trade on, we put a stop loss in, and we mentally should have prepped before taking the trade to already be accepting of being stopped out. Okay, I'm planning this trade out. Yep, that's where I'm gonna, wherever it's gonna be is gonna be where my stop loss is. And then just process that so that you're already accepting of, yeah, okay, if I'm at that point, I'm wrong for the time being, and I'll assess it. But I'm quite happy to be stopped out at that point. So you work through that. Where the problem that a lot of traders have is they don't work through that. They put a trade on and then immediately start to feel stressed. It's because they haven't worked through the acceptance of being stopped out prior to taking a trade. But even then, I don't really want to go into that too much at the moment. I want to just talk about the price uncertainty of what price is doing. And there are times when price is pulling back, and it can start to feel like, let's say the euro starts pulling back. It's had a bit of a bounce this morning, but yeah, they're coming off. I think they're all collectively coming off from their highs ahead of the US numbers coming out later. Um, but I've already assessed all of that, and of course, the euro can pull back further yet, and it will still be entirely within the context of this move that we've had. Of course, it could pull back further. I think this is fairly shallow at the moment, and so yeah. But if it gives up today's gains, it's not some massive catastrophe for the euro dollar. It's just that it's not ready to go at the moment. And bearing in mind, we've still got tariff day coming. As we said this morning, when the euro is up more, yeah, it's probably going to be a fair bit of flip flopping around between now and then. So if we've already met that challenge psychologically ahead of taking the trade and mapped out and said, yeah, okay, like for me, yeah, okay, I know that I may be in a bit early, or this, or shallow at the moment, still at 108, or this area here, still quite a shallow retracement, and there's scope for more. But if I've already processed all of that, then I'm better at dealing with, oh, okay, if it does come down further. Now, there's two different ways. It could come down further and I can just sit underwater for a while and then it comes back up. And again, or it could come down and stop me out. Now, again, when we go underwater on a trade, we have to go back and look at past instances where that's happened. Just because you've gone underwater, and look, please do remember this is a back to basics session. For many of you, I'm preaching to the converted, and but this is a back to basics session. I always say that. So it's for people who do need this sort of stuff. So go back and find instances of either from personal experience of when you've been underwater in a trade and then it's turned turned back for you, or just previous patterns, pullbacks, whereby you say, yeah, I would have bought or sold here, or bought there, and yeah, I would have been underwater for a while. So much like that is a good example there, where on that entry, not the entry from up there, but the entry from here, went underwater. And I remember, there were plenty of people in the trading room at the time. I say plenty, but I'm sure there's a fair few who were probably at that point thinking, yeah, we're probably going to retrace higher back into the prior high at 107 and all of that. And that's fine too. That's just a view. But it's a good example of the fact that they don't always do the bigger retracements. So now it might happen, but it comes back down to that whole processing of, okay, why do I want to get in at 108? Why do I not want to wait? Because it could do a larger retracement. Well, it could do, but as I've already said, um, it might not do as well. So quite happy to at times say, do you know what? It's done a bit of a retracement here. I'm okay with that level with a given stop loss, and I dip my toe in the water there, and we'll see how it goes. And if it doesn't work out and price comes down that bit further, it's still not a done deal that's a complete rollover. It's just a slightly deeper retracement. And that brings me on to the next point. Right. Okay. So if we've got a deeper retracement, there's a nice example back here in August, July of last year. So if I put now into, replay mode here, I remember this one. Let's take it forward one more bar. Right. Now, at this point, again, we've just seen the chart knowing what happens next. But no, look at it in real time because our eyes deceive us. We just look at something. So if I take this back first, actually, let's just get rid of this first of all. When we see that move with the benefit of seeing what happens afterwards, the charts are distorted. So as we see more price action going forwards. So that just looks like oh yeah, it's a fairly logical pullback. It's a pullback to the daily 50 zone. It all looks quite logical, but that's why it's so important to, even if you just got a piece of paper, um, to get rid of what happens next if you're just using, I don't know, another charting software, I don't know, MT4 charts or whatever that may not have that, then it's really good to do it. Because when you look at it in real time, you think, oh, yeah, things are certainly looking a bit more uncertain at this moment in time. Oh, yeah. Well, yeah, it has made at that point. I remember this because I remember a lot of trades that I take. Yeah, it had got a lower high confirmed once that sort of higher high came in and breached that high there, and there's our low here. So okay, we've got that going on, but it's still a bit uncertain at that point. So you've got to process all of that and say, yeah, it is a bit uncertain in real time here, but um, that's what it's done. It's pulled back into this moving average zone here, and at that point, no, I still want to be on the bigger time frames. Based on the bigger time frames, at that point, I still want to be long. And so it's a good zone to be getting long. I can't remember the exact, well, I definitely remember getting long on, the reason I remember this on this day was because I was actually on holiday. I was sitting on a beach, wasn't I? That was August of last year. Yeah, I had to take myself away, struggling to get 4G. I had 4G, but it was relatively weak, and trying to put orders in. I can't remember if I was adding to what maybe I was already in, or it was or it was freshly taken on that day. I'd have to go back and have a look on the spreadsheet. But the point is, as soon as price starts moving up like this, all of that prior decline looks very different, and so hence why don't just look at a chart and look back at little pullbacks and stuff. Put it into real time mode, or put a bit of paper over the right hand side of the chart, because it always looks different when you've got the benefit of all the data coming to the right hand side, because all of a sudden that doesn't looks perfectly rational now. Oh yeah, that was just it was just a pullback. Yeah, it was logical. Yeah, it was just into that 50 and the cluster of moving averages. And well, it doesn't always look like it in real time. So that's the point there. This whole rejection, so to speak, at that point, yes, it's still, you still don't know at that point there that, oh, is this about to roll over or whatever? Is this just a complete rejection? We're about to roll all the way back over to the lows. Well, we never know. But what we can know is there enough? Is there enough going on to say, yeah, some point around here, I want to be a buyer? And it's no different right now on the euro or on the pound. Well, if they pull back a little bit more, there'll be a point where it'll feel like, oh, is this about to? Are they about to roll all the way over? And so therefore, this is a complete rejection, and oh god, they're rolling all the way over. Or is it just what it says on the tin? It'll never. They rarely look pretty in real time, and usually because from both a price perspective and probably from a news perspective, it always looks in real time like, oh god, you're on the wrong side of things because the news is whatever it might be. At the moment, it's going to be tariff news over this next week. That might, if we're going to pull back, then it'll be, tariff uncertainties. As much as this morning it was, oh no, tariffs maybe not going to be quite as harsh. But of course, that's, as I said this morning. Well, we've got a week yet to flip flop around that whole subject. And anyway, and that's how you deal with that uncertainty. It's going through these exercises of just going back over past price patterns, putting them into real time, and saying, "Oh yeah, in real time that didn't look quite as good as it might do now." A classic example is of a divergence that took place in 2023 down here. There it is, down here. And I like coming back to this one because things didn't look too bullish at that stage. We'd got the Silicon Valley Bank blow up. We've got Credit Suisse blew up on that day there. A lot of uncertainty about these mid-tier banks in the US, and then Credit Suisse having exposure, and then it ended up getting bought out by UBS. But a lot of uncertainty at that point. You just come back over a chart, just try and have it in a point where it looks nicest. But and you say, oh yes, yeah, we had divergences down here on the daily chart. Obviously, it was a divergence on the 12-hour. Most of you know as well. So I've got a feeling it was a double divergence on the 12-hour chart. But again, we look back at it and we say, oh yeah, that's all fair, that's all fine. Yeah. No, put it into real time, and this is where the benefit of experience comes, because I can just go back year after year after year and pick trades that I've been in where, you know so you're picking real examples, not just an example. So these are all real examples of real trades. So if we put this into replay mode, all of a sudden it's going to look very different, a lot more uncertain. Oh, price has rejected the daily 50, it's come off massively. All of this uncertainty towards eurozone in a way because of the Credit Suisse at that stage. And one would think from a fundamental perspective at that stage, well, surely the euro is going to roll over here. We're in a risk off environment, and euros, as we saw with that rejection, oh dear, that's not looking so good here. And then, so again, taking it into real time, seeing what something looks like in real time, because very often it can look, I can, the benefit at the moment is a lot of these examples, I can remember what was actually going on at, from a fundamental perspective, what in the news at that stage, or whether it was an economic release day or whatever. But even from a technical perspective, in real time, it's probably not looking quite so pretty at that stage. And yet, as we were to find out that, okay, we had the inside day, still not, of course it feels very uncertain at that stage. And I remember saying at the time, yeah, things don't look great, but I've got to take the trade. So and then of course then it started to go. So time and time again, back over these examples. Let's get rid of that. These past examples to help us with when we're in trades where sometimes, like that one back from 2023, yeah, probably had very little by the way of being underwater, but there are other trades which go underwater but still end up working out okay. And so, that one back there, that entry, or certainly that entry from there, 105.80, spent a good few days, several, since taking it because it was on that day, of being a bit underwater, a bit in profit, so to speak, and then back underwater, and so just have to. The more you go through it, the more you can build that confidence. That's what that's all about. So, moving on to my points here, I took a screenshot of some of these comments from last week, and so I wanted to pick out. And this is why really I'm just tapping into what that whole uncertainty that the larger the masses out there struggle with. And so let's have a look here. This person here, I think, right, I think this, I I just took a screenshot. I think this was that person's comment here as well. That was it, because he wanted to know about a realistic timeline for a retail trader to be consistent. But anyway, I love that word. um, but yeah, and because he was saying up here, I haven't been consistent yet. I've been trading for 3 years. And he said, I've been working on it like a dog for ages. I haven't been consistent yet, but I'm getting much better. I lose hope sometimes. And so, again, that's so typical. Well, just because you're 3 years into it, it's not a guarantee that it's that you're going to be have amazing, in his words, consistency at that point. And so, and then we've got this other chap here. Psychology is definitely the hardest hurdle to overcome in trading. Yeah, sticking to a strategy. I'm getting much better at stopping myself from taking bets rather than real trades based on a strategy. Right. Okay. So I guess this person, this manifest, really wanted to know. He's 3 years in, wants to know what's a realistic timeline, and that's a good question, because if he's 3 years in, he's probably thinking, is it just me or whatever? But he's saying that he's certainly saying he's improving. But I thought that was interesting when he said, I lose hope sometimes. And I think that's really important. And I did a video at the weekend just on the YouTube channel, almost, yeah, sort of along that subject, really, whereby in this person, he's 3 years in and he loses hope sometimes. And I did this video on this another trader who'd been trading probably only about a year or so, and quit. And you cannot, and they're very obviously, there are very many reasons why people will quit. They might quit because they fear the market too much, and so uh, fear of losing and all that sort of stuff they can't get on top of. It can be a multiple reasons. This trade, I think the trader I was talking about the weekend, was quit because couldn't get on top of his other emotions, such as frustration and anger at times, and couldn't get on, and blaming the market is wanting to blame the market for getting stopped out and stuff, rather than you know taking the blame and just saying, well, maybe I can approach things slightly differently, or at least needing to accept that that's perfectly normal. So coming back to this chap, I lose hope sometimes. Yeah, you can imagine. That's what the subject of today's session is, on rejection. So when we're you know constantly rejection, um, I used to use constantly we are being rejected, and we have to build that thick skin. And I was chuckling at the beginning of this session because I used to use the analogy of, like, when I was 18, I used to go to nightclubs. Do you remember when nightclubs used to exist? And used to go to a nightclub on a Saturday night after a pub, because the pubs used to shut at 11 p.m. Do you imagine? So, and pubs didn't used to open until what, 7 p.m. I think pubs, when I was 18, pubs weren't open all day. They used to open at lunchtime for 2 hours, then they'd close, and they would open at 7 p.m. and close at 11. So you couldn't do late drinking, or you couldn't even do all day drinking. So unless it was a bank holiday, and then their licenses were allowed to they were allowed to stay open. So you used to go to the pub at 7 p.m. You only just got in there, and it's last orders. Exactly. So where do you go to stay out as a youngster? You go to a nightclub. No, exactly. And the same in pubs as well, Macca. Yeah, good point. Oh, guys, so walk into a pub at the beginning of the night and think, oh, God, the smoke. And then once you'd had a pint, then the smoke didn't seem to affect you as much. But go clubbing on a Wednesday, yeah. Certainly when I was a student, yeah, all of that as well. So anyway, so yes, when I was a student, you'd end up in a nightclub, and you might go over to a girl and whatever, try and get her attention, and I had to get used to rejection. So rejection for me started at an early age. So, but in all seriousness, I was just using that an example. I never used to go over to girls and talk to them. Well, sometimes yeah, anyway, but most of the time, no. But anyway, so you have to get used to rejection all of the time in all sorts of walks of life. Yes. Um, and it's the same, of course, in trading. We're constantly having to deal with that, and the better we get at embracing the the rejections as they come along, and sometimes just laughing them off, because sometimes you can literally get stopped out. You know what it's like. You get stopped out, and then you literally, the market's just taken you out almost to the pip, and then all of a sudden it's carried on back up or whatever, and you have to laugh. But again, I forget that people don't laugh. They'll literally be crying on something like that, or getting angry, frustrated, all of those emotions. Whereas really we should just laugh it off, because if we can, I always say, if we can gamify the market, that it's a game, it's a big giant game, and the market is an entity which is just trying to win the game. It's trying to put us off. It's trying to get us to become a statistic. It doesn't know whether you've been trading 20 years or 2 years. It doesn't care. It's still going to try and probe away at you. So if you've been trading 20 years and you've got thick skin, it's not going to do anything to you. But if you've been trading 2 years and you've got very thin skin to rejection, it might just get you if it keeps on probing. And this is the thing, gamify it. And it's just the market trying to get at you. The market wants as many people to fail as possible or to quit. And if we always keep that at the back of our mind, and we gamify it a bit more, and so that we can deal with the rejection rather than, oh God, I've been stopped out, oh, this is terrible, I'm not going to take the next trade, and and all the other things that can happen. Or we get angry. Remember young Carl Akinlami, and I can use his full name because we talked about this publicly as well in an interview. But Carl used to, has thrown screens at the wall in anger. And the weird thing was with Carl was that he was the calmest person in everyday life. He did not have anger issues at all. And he swore to me, he said, I've never been in a fight. He said, I'm very calm in my normal life. He said, I've never had anger issues. But yeah, he's bitten his desk and he's thrown screens and he's smashed up his computers and, literally in his first sort of 6 months of trading. So he got over it. Actually, he did get over it. He overcame it in the end. But in his first 6 months, he was terrible. So people will succumb, and so the more that we can accept that, okay, this is the game that the market's going to do with us, and sometimes the market's just probing whilst we're still in a trade, and it can put us off, even if we haven't been stopped out. It can wear us down if we're not careful and feel like, oh god, I'm going to get stopped, and then afterwards the market goes up, and then you're like, why did I waste all that energy, all that negative energy? And this is the thing, that it's very easy to get caught up in wasting, essentially, or having negative energy. So, because it just wears you down. And that's where that whole cycle of emotions comes from. So, it's not that the outcomes or the outcome of our trading is important. Of course it is. But there's no point in wasting the energy, because there are countless trades that we get into that go underwater that end up going up, or whatever, or to our targets, whatever. Why did you waste all that energy? That's not good. It's not healthy for you. Cortisol levels, elevated cortisol, the stress gene running through your body every time these things happen. And again, the more that we can have greater self-awareness of all of those things, the more we get better at shrugging all that stuff off. I just come across this all of the time with traders, not so much necessarily through the trading room, to be fair. Now and again, of course, someone will say something over as over a course of a year, things come up, of course. But um but more so just through um communicating with people in that wider world, so to speak, of trading. That when they say the things that they do, and you think, yeah, you've got a lot of demons there, or battles that you're not understanding. As we often say, too many of these traders are looking for a holy grail. That they want the holy grail of, well, if I get in at a given price point, if I get in here, they just want to be like immediately into profit. And of course, there's plenty of trades that do that, but there's plenty of trades that don't as well. And so they carry on searching. And as I've said before, they end up searching for something that will give them that outcome of hardly, of just not, they want to be right 8 times out of 10. and and they can deal with like 2 losers out of 10 sort of thing, and that's what they want. And in order to get that, they are constantly looking for what? A technical solution to what is a psychological problem. Such a good line, that they're looking for a technical solution to what is actually a psychological problem. So, their desire to be right 8 times out of 10, their desire to, on the ones that are right, to just immediately pop into profitability, and they're not comfortable the rest of the time, and they're hoping and praying to God or to whoever that the market will come back for them or whatever. It's just not, as I always say, it's not healthy. And so the calmer that we can trade at, the more of that narrow emotional range. We can't not experience any emotions, but the more stunted the emotional range, the better we are, because then we're not experiencing stress, ultimately, which then means that we trade better, at least from a psychological perspective. We're not stressed going into the next trade, or fearful, or angry, or whatever. That guy that I talked about the weekend, it wasn't Carl Akalami. Like I said, this guy had only been trading a year or so, but had a lot of, maybe not anger to the same extent as Carl did, but wanted to blame external sources, wanted to blame the market, just getting angry, and then just say, "Oh, this is rubbish. I'm off," sort of thing. You think, "Oh, what a waste!" This person just couldn't handle, essentially, the rejection, and so just say, "Oh, I'm going to do other things," and so I thought it was a good example there. And then you come back to this, and this is the same stuff. Um, this person saying, I lose hope at times," and you think, right, yeah, and I understand that, because they don't know any different. I think if you're on your own, you're not in a part of a community, you don't know any different, so it can be really tough. But sometimes just to be told, no, 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 it's perfectly fine. You're only 3 years in. Keep going. You're fine. You're probably fine. What you need to do is work on your mindset. Yeah, and but again, from this person's questioning, like here, what would you say is a realistic timeline for a retail trader to be consistent? You can see, as always, what traders are looking for. They're looking for certainty. Always. We'd all love certainty. We'd all love to have certainty, knowing that for every trades that we take, 8 of them are going to win, 2 are going to lose, yeah, and it's like an average, and it's an ATM machine. Of course, we all want that. We'd all love to have certainty, but it's not the reality. So we have to embrace the uncertainty of trading, the fact that it doesn't work that way, and that you know statistically we are going to have runs of losers. Statistically, we will also have runs of winners, but we got to put up with all of that stuff. But that's what people want, is consistent. And you hear this all the time: I just want to be consistently profitable. You're like, well, okay, so if I gave you a strategy, that, or whatever, an approach to the market, that's going to give you, where's my no, it's going to make you 50% a year, and you're going to be risking 1% per trade, and you're going to be doing an average of X number of trades per week, and that will give you 50% a year. And many of these people will be like, yeah, I'll have that. Yep, absolutely. And then you tell them that, yeah, but you'll actually you'll make that 50% in a year, but actually you'll only have 4 winning months. Or maybe 5 if I'm nice, or whatever. And again, they might, on the face of things, say, yeah, that's okay. Yeah, just give me the 50% of the year. That's fine. The four winning months, and but 3 of those winning months come in the last 3 months of the year. You just know it's so tough, isn't it? It would be so difficult, and yet that's the sort of thing that can happen if you're, especially swing trading, and that this stuff comes in clusters at times, and but people want the consistency, and they don't want that, those other numbers. I know I've talked about this before, but I think it was the beginning of, yeah, so it was January of last year. Uh, One of the best performing, in percentage terms, hedge fund managers for 2023, he did something, anyway, it was over 100%. So he did over 100% in the year of 2023, with I think it was a 24 percent win rate. So he was only right something like 24%, something like that. So again, traders will be like, yeah, great, I want some of that, but can they handle that? Okay, that's maybe a bit more extreme, so to speak. He was looking for bigger risk rewards, and so traders don't have to go that low or as far as the win rate is concerned. If they're trading a mechanical style, they can engineer the style to give them a higher win rate, as we often show in Strategy Corner when we use the software. So, but nevertheless, that sort of stuff goes on. And so my point of the session is dealing with rejection in all its forms. So on a given trade, whether the trade becomes a loser or a series of trades, um, or even when we're in a trade, feeling the rejection when you go underwater, so to speak. You haven't even been stopped out. But how do we go around it? Like I've already covered off, the best way is to go back over the charts, put them into real time, look at all these other instances that have taken place, because it really does help. It's just about confidence. That's essentially, trading's a confidence game, isn't it? And so we're trying to trick our natural fight or flight responses as much as possible to give us confidence. If we can trick, if we can trick those natural urges to run away, i.e., fear, or front up and get angry, or other kinds of frustrations, or maybe overconfidence as well, then if we can if we can iron those out, then certainly, and we can trade confidently. I don't mean overconfidently. I just mean with a level of confidence that we can accept the rejection of the markets that's going to happen, or the uncertainty when you're even looking at a market and you're thinking, oh, I know I've got to take this trade, but I really don't want to. Well, sometimes they become the best trades, of course, when in the pit of our stomach. The stomach can still tell us, and still tells me at times, oh yeah, this feels a bit uncomfortable here. This doesn't, in the pit of my stomach. But I'm not um, I'm not coursing. I haven't got cortisol coursing through my veins. It's just in your stomach. Your gut instinct is like, yeah, this ain't gonna work. I'm definitely going against the prevailing trend or whatever it is at that point. But if it fits your criteria, you still got to take the trade, and you just embrace it, by doing all of these things, accepting the rejection, all that other stuff, and accepting that, yeah, how many times have you been in trades when it's not felt right at the beginning, and yet it still worked out? Again, reminding ourselves of all of that. That's why I always say, it's really useful when you have a given trade experience to log it and to make a note on it, maybe take a screenshot, and write what your emotions were like at outset and at conclusion, because there are many trades that we all take that we're like, oh yeah, this one doesn't look like it's going to work out, and it feels like I'm going against whatever the news, the fundamentals, whatever, and yet they do. And like any of you, I've been in loads of them. Excuse me. Whereby it doesn't feel like, yeah, I'm probably not going to be in. I'm not. This doesn't feel like it. I'm going against everyone in the world. And my my favorite example of that is that Euro long in 2017. Because the whole world was anti the euro at that point. It felt, and so that one certainly felt like very much a contrarian trade. That was what, 8 years ago now. But even actually, in 2023, so if I go back to the beginning of 23, where are you? Oh no, gone too far. No, sorry, 2021. Yeah, there we are. So here, at this point in 2021, although it was the right thing to be on the short side, and I set my stall out in the December saying, right now, got to be short. Why? Because at that point, yeah, we had some divergences. Do we have divergences on the weekly? I can't remember. I'll have to go back. I'm not sure. We'll have to have a look. Um, but the again, headline articles saying the demise of the dollar, all that sort of stuff, and all the reasons. Lots of articles out at that point saying why the euro was going to go to 140. So sentiment at that point was very bullish. The euro very bearish. The US dollar, and the euro had come up into resistance here at that point. I'm sure we had divergences on the weekly. I'm going to have to go and have a look now. Was it on the weekly at that point? Or maybe not. Let's have a look back here. Oh, yeah. Yeah, it was. Yeah. So we had these divergences on the weekly, very clear and clean at that point but it doesn't, but again, like I'm trying to say, it doesn't, in real time, you've got all of the reasons to take a given, wrong way, keep going. You've got all the reasons. How am I doing for time? Right. You've got the reasons to take the trade. It's the technical reasons, but you're still going to feel like you're going against the prevailing trend. I mean, look at that trend. It had been running for a reasonable amount of time from earlier in 2020 until basically the end of December. It topped out, or beginning of January, it topped out. And so you're still going to feel like, yeah, I mean, I've got all the reasons to take the trade. Still doesn't necessarily mean that it's easy. And when we take them, and if they start running, I'd already had a few attempts at it because I was trying to get in off of 4-hour charts at the time through the Christmas period. I think I'd had 4 losers in a row on it already, and before it took. And so, of course, that's for a lot of people, that's going to have a part to play. And yet, actually, overall trade, and even through the downside move here, I think there was a bit of a retracement that came. There it was. A bit more. I think that was it. There. No, a bit more actually. I'm still getting some stop outs along the way as well on other entries when we retrace, but retrace further up. Let's go back. There it was. So that stopped me out and I had to get back in. I remember us getting back in based on this is 4 years ago, and I still remember it. It was on a 15-minute, sorry, 30-minute chart of, what was it? I think it was a stick sandwich, actually. So, yeah. But we'd already had some profit on the downside, and then this rolled over, and then that one all went really nice. So just staying with it and not getting thrown off and thinking, oh, right, that's it. We're going to go high now. Now, sometimes there's a point where you'd say, yeah, I need to switch my analysis. But that wasn't the case at that stage. The divergence was still in the background on the weekly chart. How am I doing time, right? So no, got to stay with it, stay with that background sentiment and all of that. We're only a few weeks relatively in at the moment into this year, into that year. No, got to stay with it. So the market's going to try constantly and throw us off and reject us. And if you haven't been working on the mindset, then you're more likely to succumb. Oh God, I've been stopped out. No, it's going to go higher now. That's it. I'm not taking any more shorts. I've had a little bit out of it, or whatever. Or you don't even want to trade it up at the top in the first place. All those reasons. And it all comes back down to how the market is constantly trying to make us feel uncertain and rejection. And of course, there's plenty of times when we are getting rejected. And that's the hardest thing, because we are getting stopped out and having runs of losses and stuff. But we got to also keep reminding ourselves of all the other stuff that happens, because it's the few trades in relative terms that pay for the losses, as we all know. So there we go. So that's the theme of today's Back to Basics. I'm about done. Yeah, blimey. 2 minutes until Shelley is on, so I better shush. Anyway, for our anyone who's newer, I hope that that has been of use today, just covering all of that ground. So I'm going to press stop on the record.